Welcome back to the deep dive. Today, we're tackling a really big one. It keeps finance ministers up at night, costs companies millions. U.S. taxation of global income.
It's a beast. And we're not just skimming the surface. We're diving into the legal architecture, specifically how the U.S. taxes income earned anywhere in the world.
Yeah, looking at how they try to stop companies from just, parking money overseas indefinitely. We're talking controlled foreign corporations, CFCs, and passive foreign investment companies, PFICs.
Exactly. Those are the big anti-deferral mechanisms. And then, just as important, how U.S. taxpayers can actually lessen that tax burden, hopefully avoid double taxation.
We've got a stack of technical stuff here, court cases, regulations, even some proposed changes for 2025. The goal is to make this, navigable for you. Break down the jargon.
And we have to start with the absolute bedrock principle, worldwide taxation. It's kind of unique for the U.S. among major economies, even after the big 2017 tax reform.
Right. So if you're a U.S. citizen or a resident, the U.S. government says, we tax your income, doesn't matter where you earned it. Your assets could be anywhere, you could live anywhere.
Doesn't matter. The legal basis is, it's powerful, the 16th Amendment. Congress can tax income from whatever source derived. No geography mentioned.
And this isn't new. There's that old Supreme Court case, Cook v. Tate, from way back in 1924.
That one basically cemented it, said Congress can tax a U.S. citizen's income even if it's all from property abroad, even if the citizen lives abroad. The tax obligation follows the person, not just the location of the money.
Okay, so that's the foundation. But, just saying worldwide taxation didn't stop money from flowing offshore, did it?
Not at all. Because there was this massive default rule historically. Kind of made the system optional in a way for global companies.
Which one?
Tax deferral. Simple idea, really. Foreign corporate income earned outside the U.S. Well, it wasn't taxed by the U.S. until it was actually brought back, repatriated, usually as a dividend to the U.S. shareholder.
So just leave the profits overseas in your Irish or Bermudan subsidiary indefinitely, and poof, no U.S. tax.
Pretty much. If you manage it right, deferral could be almost as good as exemption. And that's exactly what led to the CFC rules back in 1962. They had to stop that.
Okay, so to stop deferral, they brought in these anti-abuse rules. What do?
They impose current taxation, sometimes called imputation. Basically, the U.S. shareholder is treated as if they receive the income right away, even if the cash is still sitting in the foreign company's bank account. You owe U.S. tax now.
And the two big hammers for this are the CFC and the PFIC rules.
Those are the main ones, yes.
All right, before we get into the weeds of what makes a CFC, we need to back up a step. Our sources really stress this point. How the IRS sees a foreign entity isn't always how its home country sees it.
Yeah, this is absolutely critical. You have to distinguish between just an organization, any group with a common goal, maybe commercial, maybe not, and a proper legal entity.
A legal entity being more specific.
Much more specific. A juridical person, they call it sometimes, needs organizational unity, its own separate property, its own balance sheet. Independent liability, meaning the entity itself is responsible for its debts, not the owners directly, and it has to be able to, do business in its own name.
So, every legal entity is an organization, but not every group calling itself an organization is a full legal entity.
Exactly. And here's the kicker from the regulations. U.S. federal tax law, the Internal Revenue Code, decides how that entity is classified for U.S. tax purposes, what the local law in Germany or Japan calls it. Irrelevant to the IRS.
That's wild. So you don't even need a formal company registration necessarily.
Not always. The IRS looks at the substance. If, say, two parties have a joint venture agreement, they're carrying on a business together, splitting profits, the IRS can just say, right, that's a separate entity for tax purposes, even if it's not formally incorporated anywhere. A de facto entity.
They follow the money, the economic reality. Okay, so once the IRS decides an entity exists, how do they classify it for tax?
There are three main commercial types we need to worry about.
Let's run through them.
First, the disregarded entity. Think of it as invisible for tax. It's not separate from its owner. All its activities, income, assets, they're treated as if they belong directly to the owner, like a branch office or just a division.
Okay.
Second, the pass-through entity, like a partnership, typically. The entity itself does the calculations, figures out income, deductions, credits, but it doesn't pay the tax. Instead, those tax items flow through directly to the owners or partners, and they report and pay the tax on their individual returns.
Got it. And number three, the big one for offshore planning.
The Subchapter C corporation. Now, this one is treated as a separate taxpayer in the U.S. It pays its own corporate income tax. This leads to the famous double taxation issue tax at the corporate level, then again when profits are paid out as dividends to shareholders.
But that separation is also its key advantage for planning, right?
Absolutely.
Yeah.
Because it's a separate taxpayer, its earnings are generally insulated from the shareholders until distributed. The corporation's tax attributes stay inside the corporation. That's what creates the possibility of deferral, unless the CFC or PFIC rules kick in.
Which is why our source is called a C Corp, the principal instrument of offshore planning. It's the wall you build between the income and the U.S. owner.
Precisely. So when the IRS looks at a foreign organization, how does it decide if it's a corporation or something else by default? It really boils down to two things.
Okay, what are they?
Number of owners, is it just one or two or more? And the liability of those owners, do they have limited liability, meaning they're generally protected from the entity's debts, or unlimited liability?
And what are the default classifications then?
Okay, defaults. If it's got two or more partners and at least one of them has unlimited liability under the local foreign law, the IRS treats it as a partnership by default.
Makes sense. What about a single owner?
Single owner, unlimited liability. That defaults to a disregarded entity, just an extension of the owner.
And the crucial one for C Corp status.
If the foreign organization has two or more members, and here's the key, all members have limited liability, then it defaults to being classified as an association. And an association, for U.S. tax purposes, is a corporation, a C Corp.
So think of a standard UK limited company or a German GmbH or a French RL. All the owners have limited liabilities. So boom, the IRS sees them as C Corp by default.
Exactly. Doesn't matter what the UK or German tax system calls it. The limited liability creates that separate legal and economic shield, and that triggers U.S. corporate status by default.
But there's a way out of that default, isn't there? The check-the-box selection.
Yes. Form 8832. The check-the-box rules give eligible entities huge flexibility. An entity that would normally default to being a corporation because all its members have limited liability can actually elect to be treated as a partnership instead.
Why would they do that?
Well, if you elect partnership status, it becomes a pass-through. The income flows directly to the owners each year. That eliminates the deferral issue entirely, but it also means immediate U.S. tax for the owners. Sometimes that's preferable to dealing with the complexity of CFC rules later.
But you can't always check the box, right? There are limits.
Correct. The IRS has a list of specific foreign entity types that are considered per se corporations. They're stuck as corporations for U.S. tax purposes, no election possible. The list includes things like certain public limited companies in various countries. Our sources mention a Russian open joint stock company as one example. For these, the IRS says, nope, you're a corporation, end of story.
Okay, so we've established the corporation as the key vehicle. Now let's tackle the first big anti-deferral weapon. The Controlled Foreign Corporation Regime, the CFC rules. Came in back in '62, you said.
1962, yes. And they are widely considered among the most complex tax rules anywhere in the world.
So what actually is a CFC? How's it defined?
The definition is in Internal Revenue Code, Section 957A. A foreign corporation becomes a CFC if, basically, U.S. shareholders own more than 50% of it. That ownership can be measured either by voting power or by the total value of the stock. If that 50% threshold is crossed on any day during the tax year, it's a CFC for that year.
More than 50%. Seems straightforward enough, but I bet the definition of U.S. shareholder is where the complexity lies.
You bet right. A U.S. shareholder for CFC purposes isn't just any U.S. person who owns stock. Under Section 951B, they have to own 10% or more of the foreign corporation's stock, again, measured by vote or value.
Okay. So only the bigger U.S. owners count towards that 50% control test.
Exactly. You need to own at least 10% yourself to even be counted in the control calculation.
Let's make that concrete. Say I'm a U.S. citizen. I own 49% of a foreign company. The other 51% is owned by, 60 different foreign individuals, none owning much. Is that a CFC?
Nope. You're a U.S. person, but you don't meet the more than 50% control test yourself. And since no other U.S. persons own 10% or more, the total U.S. shareholder ownership is just your 49%. Not enough.
Okay, now the classic planning example. What if a foreign company is owned 100% by, say, 11 U.S. citizens, but each one owns exactly 9.09%?
The 11 equal owner structure, that is not a CFC.
Even though it's 100% U.S. owned?
Correct. Because while U.S. persons own all of it, no single person meets the 10% threshold to be defined as a U.S. shareholder. Since there are 0 U.S. shareholders, according to the definition, the ownership percentage counted towards the 50% control test is 0. Result: no CFC status.
So that 10% individual ownership threshold is like a minimum barrier. Below that, the IRS figures you probably don't have enough clout to be using the entity for serious tax schemes.
That's the idea. But of course, the IRS isn't naive. They know people will try to structure around these thresholds. That's where the anti-abuse and attribution rules come in.
Attribution rules, meaning ownership gets combined.
Yes, very broadly. The rules in sections 318 and 958 are designed to prevent people from just splitting shares among family members or related entities to stay below the 10% or 50% lines. Stock owned by your spouse, kids, grandkids, parents. It can be treated as owned by you.
And what about layers of companies?
The same idea. If you own stock through a foreign partnership, corporation, or trust, the rules can look through those entities and attribute the underlying foreign corporate stock back to you, proportionally. They try to trace the ultimate economic ownership and control.
Okay, so let's say the thresholds are met, the attribution rules apply, or someone owns enough directly. It's a CFC. What happens then? What's the actual consequence?
The consequence is potential Subpart F Income inclusion. That's the core taxing mechanism found in sections 951 to 965. If you are a U.S. shareholder, remember a 10% plus owner, you generally have to include your pro rata share of the CFC Subpart F income on your personal U.S. tax return for that year.
Include it, even if you didn't actually receive any cash dividend.
Even if not a penny was distributed. That's the imputation part. The income is deemed distributed to you for tax purposes.
And how is that income taxed? Is it like a dividend?
Generally, no. While it feels like a dividend economically, it's typically taxed as ordinary income, often at higher rates than qualified dividends. That's a key point.
Okay, but what about double tax? If I pay tax now on imputed income, do I pay again when the CFC eventually does pay a dividend?
Thankfully, no. The system has relief for that. Income that you've already paid U.S. tax on under Subpart F is generally tracked, they call it, previously taxed income, or PTI. And when that same income is later distributed as an actual dividend, it comes out tax-free in the U.S., avoids taxing the same dollar twice.
Good. So what kind of income gets hit by Subpart F? It's not everything the CFC earns, is it?
No, definitely not. Subpart F targets specific types of income, mainly foreign-based company income, or FBCI, defined in Section 954. The idea is to hit income that's considered easily movable, passive, or lacking a real economic connection to the CFC's home country, stuff that looks like it was shifted there just to avoid tax.
Pocket money income, I think one source called it. What are the main types?
There are several, but the three big ones are where most of the action is. First, foreign personal holding company income, FPHCI.
Sound like passive stuff.
It mostly is. Think dividends, interest, royalties, rents, annuities, gains from selling stocks or bonds. Your typical investment income.
But are there exceptions? What if the CFC is actually in the business of renting property?
Good question. Yes, there are important exceptions. If the royalties or rents are derived from the active conduct of a trade or business, like a real estate company actively managing properties, or a software company actively licensing its product, that income might be excluded from FEHCI.
What about payments between related companies within the same country?
Also an exception, often called the same country exception. If a CFC gets dividends or interest from a related corporation that's organized in the same foreign country, and that related company has substantial assets and operations there, that income is generally excluded. Let's groups manage cash within a single foreign country without triggering immediate U.S. tax.
Okay, FPHCI is mostly passive. What's the second big category?
Foreign-based company sales income, FBCSI. This one directly attacks what's often called the distributor center problem.
Right. Walk us through that classic scenario.
Okay. Imagine a U.S. parent company manufactures goods, let's say, in the U.S., country A. It sells those goods to its subsidiary, a CFC, located in a low-tax country, maybe Ireland, country B. The Irish CFC then immediately sells those same goods to unrelated customers in, say, Germany, country C.
And the goods maybe never even physically went through Ireland.
Exactly. The profit lands in Ireland purely for tax reasons. The Irish CFC didn't really do anything other than paperwork. FTTSI rules are designed to see through that and tax that profit currently in the U.S.
What are the specific criteria for income to be FBCSI?
It generally involves a purchase from or a sale to a related person. The property involved has to be a personal property, movable goods. And critically, the property must be manufactured, produced, grown, or extracted outside the CFC's country of incorporation, Ireland in our example. And it must be sold for use, consumption, or disposition outside that country too.
So how can the CFC avoid this if it actually adds value?
Yes. The main way out is if the CFC manufactures the product itself in its home country. If it doesn't manufacture, it can still escape FBCSI if it performs a substantial transformation on the goods in its country.
Substantial transformation. How is that measured? Is there a number?
There is. The regulations provide a safe harbor. If the CFC's direct labor and factory overhead costs incurred in its country in connection with the property are 20% or more of the total cost of goods sold, that's generally considered substantial enough. It has to be real activity, not just minor assembly or packaging.
Okay, 20% value add. Got it. What's the third main type of FBCI?
Foreign-based company service income, FBCSVI. This targets income from services like consulting, technical assistance, management performed by the CFC for or on behalf of a related person, but performed outside the country where the CFC is incorporated.
So, trying to stop a U.S. company from routing, say, management fees through a low-tax subsidiary when the actual management work is happening elsewhere.
Precisely. Prevents using a shell CFC in a tax haven to perform services that are really connected to the U.S. parent or another affiliate in a higher tax country.
Is there a threshold here, too, based on who helps the CFC?
Yes, an important anti-abuse rule from a specific IRS notice. The service income only gets pulled into FBCI if the assistance provided to the CFC by the related U.S. person in performing those services is significant. The threshold is if the cost of that assistance from the U.S.-related person equals or exceeds 80% of the CFC's total cost of performing the services, then the income is tainted.
Wow, 80%. So if the U.S. parent is basically doing almost all the work for the CFC, the IRS says, nice try, that income is effectively U.S.-derived.
That's the logic. Forces the CFC to have its own real capacity and perform the bulk of the service itself using its own resources to keep the income deferred.
Okay, those are the main types of FBCI, but there are overall exceptions that can wipe out FBCI entirely, right? Like a de minimis rule.
Absolutely. Two key ones. First, the de minimis rule. If the CFC's total FBCI and certain insurance income is small relative to its overall business, it gets ignored. The threshold is less than the lesser of 5% of the CFC's gross income, or $1 million, adjusted for inflation, but often cited as 1 hour. If you're below that, your FBCI is treated as zero for the year.
Acknowledges tiny amounts might just happen. What's the flip side?
The flip side is the full inclusion rule. If the FBCI is really dominant specifically, if it exceeds 70% of the CFC's total gross income, then the rule flips, and all of the CFC's gross income for the year is treated as FBCI. The IRS basically assumes the whole operation is geared towards tax avoidance at that point.
70%. Okay, and the big escape hatch if the income is FBCI but gets taxed heavily anyway.
That's the high tax exception, or sometimes called the high tax kickout, found in Section 954B4. If an item of income that would otherwise be FBCI is subject to foreign income tax at an effective rate that's greater than 90% of the maximum U.S. corporate tax rate, then it's excluded from FBCI.
So with the current U.S. corporate rate at 21%, 90% of that is
18.9%. So if that foreign income is already being taxed abroad at 18.9% or higher, the U.S. says, okay, that's taxed enough, we won't hit it again with Subpart F. It effectively cedes primary taxing rights to countries with reasonably high tax rates.
All right, let's move to the newer kid on the block, the global minimum tax concept. This started as GILTI and is now morphing into something called NCTI.
That's right. GILTI, Global Intangible Low-Taxed Income, was a huge part of the 2017 tax reform. The main target was income earned by multinationals from, well, intangible assets like patents, trademarks, copyrights that they'd shifted to countries with super low or even zero tax rates.
And the way GILTI was calculated originally, it was kind of weird, wasn't it? It actually rewarded physical assets overseas.
It was, yeah, definitely complex and had that effect. The GILTI inclusion amount was calculated as the shareholder's share of the CFC's total tested income, minus something called the deemed tangible income return, or DTIR.
DTIR, what was that based on?
It was a mandatory 10% return on the CFC's qualified business asset investment, or QBAI. And QBAI was basically the tax basis of tangible, depreciable assets used in the CFC's trade or business think factories, machinery, equipment located overseas.
So the more factories and machines your CFC's owned abroad, the bigger the QBAI, the bigger the 10% DTIR deduction, and the less GILTI income you had to report in the U.S.
Exactly. It created this incentive, or at least was criticized, for creating an incentive to invest heavily in tangible assets offshore, even if it wasn't the most economically efficient thing for the business, just to reduce the GILTI tax hit.
Seems counterintuitive if the goal was taxing intangible income, but that's changing.
It is. The proposed legislation, often referred to as OBBA changes, though the specific bill might vary, renames the regime Net CFC Tested Income, NCTI, starting likely post-2025. And the big structural change is getting rid of that whole QBAI DTRR calculation.
Just gone. So NCTI is simpler.
Much simpler conceptually. NCTI is essentially the U.S. shareholders' proportional share of the net tested income or loss from all their CFCs, aggregated together after excluding things like Subpart F income that's already taxed. No more artificial deduction based on tangible assets. It broadens the minimum tax base considerably.
Before we leave GILTI and CTI, we should probably mention that Supreme Court case, Moore v. United States, that just came down in 2024, right?
Yes, Moore was hugely important. The court upheld the constitutionality of the original GILTI regime's mandatory repatriation tax, which was a one-time transition tax. But more broadly, the decision reaffirmed Congress's power to tax U.S. persons on the undistributed income of entities they control, like CFCs.
So it basically gave a green light to the whole concept of income imputation used in Subpart F and GILTI on CTI.
Pretty much. It provides a solid constitutional foundation for these regimes going forward. It was a major decision for the future of U.S. international tax.
Okay, so you have this NCTI inclusion. How is it actually taxed, especially for corporations? Is it just added to other income?
It's included in gross income, taxed at ordinary rates. However, for corporate shareholders, there's a special deduction under Section 250. This deduction is designed to lower the effective tax rate on this foreign income, making U.S. companies more competitive.
And how big is that deduction for NCTI?
Under the post-2025 proposed rules, the Section 250 deduction for NCTI is slated to be 40%. When you run the math with a 21% corporate rate, a 40% deduction brings the effective tax rate on NCTI down to about 12.6%.
12.6%? That's a target minimum rate, essentially. But does the high tax exception still apply if the income was taxed above 18.9% abroad?
Yes, absolutely. The same high tax exception we discussed for Subpart F also applies to exclude income from being tested income in the first place for NCTI purposes. So income tax at 18.9% or higher abroad generally escapes both Subpart F and NCTI.
Okay, that covers the two main controlled company regimes. But there was still a gap, wasn't there? What about investments where a U.S. person owned, say, only 5% of a foreign company? They wouldn't be a U.S. shareholder, so CFC rules wouldn't apply.
Exactly. That's where the ultimate backstop comes in. The Passive Foreign Investment Company Regime, or PFIC, introduced back in 1986.
And the goal here was to catch
U.S. taxpayers who were investing in foreign corporations, often pooled funds like foreign mutual funds, specifically structured so that no U.S. investor owned 10% or more. They were avoiding the CFC rules, but still getting tax deferral on passive investments held offshore.
So the number one key difference between CFC and PFIC is?
No minimum ownership threshold for the U.S. investor. If you own even a single share of stock in a foreign corporation that meets the PFIC definition, you, the U.S. investor, are potentially subject to these rules. Doesn't matter if you own 5% or 0.05%.
Okay, so ownership doesn't matter for the investor. What makes the foreign corporation itself a PFIC?
It has to meet one of two tests based on its passive characteristics.
Test number one.
The passive income test. A foreign corporation is a PFIC if 75% or more of its gross income for the year is passive income. Think interest, dividends, rents, royalties, unless from an active business, annuities, net gains from passive assets.
Okay, 75% income test. What's the second test?
The passive assets test. It's a PFIC if 50% or more of its assets produce, or are held to produce, passive income. This test usually looks at the average value of the assets throughout the year, and you can often choose between using fair market value or adjusted tax basis, depending on the situation.
So either mostly passive income or mostly passive assets triggers PFIC status. What about holding companies? If a foreign company just holds stock in operating businesses?
Good point. There's a look-through rule for that. If a foreign corporation, the potential PFIC, owns 25% or more of the stock of another corporation, a subsidiary, it's treated as owning a proportional share of that subsidiary's assets and earning a proportional share of its income directly.
So you look through the holding company to the underlying operating assets and income of the subsidiary.
Exactly. Prevents companies from hiding active businesses underneath a passive holding company shell to avoid PFIC status, or vice versa.
Okay, let's say a foreign corporation is a PFIC. What's the default tax treatment for the U.S. shareholder? You mentioned it was punitive.
Oh, it's designed to be nasty. The default regime is under Section 1291. Unlike CFC rules, it doesn't generally impose tax annually. Instead, the paying comes later when you either receive an excess distribution from the PFIC or sell your PFIC stock.
Excess distribution, how's that defined?
It's the amount of the current year's distribution that exceeds 125% of the average distributions you received over the prior 3 years, or your holding period if shorter. So Unusually large dividends get hit.
And when you have an excess distribution or sell the stock, how is the tax calculated?
This is where the penalty really bites. That gain or excess distribution is allocated, essentially spread out, over your entire holding period for the stock.
Yeah.
Then the tax on the amount allocated to each prior year is calculated using the highest ordinary income tax rate in effect for that year, regardless of your actual tax bracket.
Highest rate. Ouch. Now, wait, there's more, isn't there?
Oh, yes. On top of that highest rate tax, the IRS charges interest, a special non-deductible interest charge, calculated as if the tax was due back in those prior years but wasn't paid. It compounds. The goal is to completely strip away any economic benefit of the tax deferral you enjoyed, plus add a penalty.
That sounds truly awful. No wonder people want to avoid the default Section 1291 treatment. Are there ways out? Elections.
Yes, thankfully. Two main elective regimes to avoid the punitive default tax and interest charge. The most common is the Qualifying Electing Fund, or QEF election.
What does a QEF election do?
If you make a QEF election, and the PFIC provides the necessary information, which isn't always guaranteed, you agree to pay U.S. tax currently each year on your pro rata share of the PFIC's ordinary earnings and net capital gains. It basically turns it into a pass-through for tax purposes, similar in effect to partnership taxation. You lose deferral, but you avoid the nasty interest charge and highest rate treatment. Income generally retains its character, ordinary versus capital gain.
Okay, current inclusion with QEF. What's the other option?
The mark-to-market MTM election. This one is only available if the PFIC stock is marketable, which usually means it's regularly traded on a qualified stock exchange.
And if you make the MTM election?
You include in your income each year the difference between the stock's fair market value at year-end and your adjusted basis. If it went up, that's ordinary income. If it went down, you generally get an ordinary loss deduction, but only to the extent of prior MTM inclusions. It forces annual gain-loss recognition based on market fluctuations.
All right, QEF or MTM avoids the penalty. Now the tricky part. What if a company is both a CFC and a PFIC? Which set of rules applies?
There's an important overlap rule, sometimes called the CFC-PFIC Overlap Rule in Section 1297 DFS. The general rule is if a foreign corporation is a CFC and the U.S. person looking at it is a U.S. shareholder, a 10% plus owner, then the corporation is not treated as a PFIC with respect to that shareholder.
So for the 10% and up owners, CFC status essentially turns off the PFIC rules. They just deal with Subpart F and NCTI.
Generally, yes. That's a huge relief because the CFC rules, while complex, are usually much preferred over the default PFIC regime.
But, I sense a but coming. Our sources flagged a problem here, especially after the recent reforms. Something about smaller owners getting caught.
Yes. This is a potentially nasty trap, particularly highlighted by the OBBBA changes impacting NCTI. The problem involves U.S. persons who own less than 10% of the foreign corporation directly, but due to the attribution rules, they are treated as owning stock in what might be called a foreign-controlled foreign corporation, FCFC.
So they don't meet the 10% threshold to be a U.S. shareholder themselves.
Correct. And because they aren't technically U.S. shareholders, they do not qualify for that CFC override rule in Section 1297. The override only protects the 10% plus owners.
Uh-oh. So what happens to these sub-10% owners who get pulled into the CFC regime only through attribution?
They could be in a terrible spot. The foreign company might be generating Subpart F or NCTI income, which could potentially be attributed to them under those rules, though often the income inclusion itself only applies to U.S. shareholders. But because the CFC override doesn't apply to them, the company also remains a PFIC with respect to them.
So they have to deal with both sets of rules simultaneously.
That appears to be the result. They could face the complexity of tracking potential attributed CFC income and be subject to the separate punitive PFIC tax regime, either the default 1291 rules or needing to make a QEF-MTM election if possible. It's a double compliance burden for potentially small owners, created by how the CFC override was written.
Okay, we've covered how the U.S. taxes this global income, often quite aggressively with CFC and PFIC. Now let's talk about relief. How does the system try to prevent outright double taxation? The big one is the foreign tax credit, right?
Absolutely. The FTC foreign tax credit, governed by Sections 901 to 909, is the main tool. And the key thing to grasp is the difference between a credit and a deduction. You can usually choose one or the other for foreign income taxes paid.
And the credit is almost always better.
Almost always, yes. A deduction just reduces your taxable income, saving you a tax at your marginal rate. A credit reduces your final U.S. tax liability dollar for dollar. Much more valuable.
But you can't just claim a credit for any payment made to a foreign government, can you?
No, there are strict qualification rules. 5 main ones. First, it has to be a tax, an obligatory payment, not just a fee for a specific service or a penalty. Second, it must be an income tax in the U.S. sense, or a tax paid in lieu of an income tax, like maybe withholding tax on royalties. Things like foreign VAT or sales taxes generally don't qualify.
Okay, obligatory income tax. What else?
Third, you actually have to have paid or accrued the tax. Fourth, the income on which the foreign tax was paid must be considered foreign source income, according to U.S. sourcing rules, not U.S. source. Fifth, the tax must legally be imposed on you, the U.S. taxpayer claiming the credit.
Got it. And even if a foreign tax qualifies, there's a limit on how much credit you could actually use, isn't there? The Section 904 limitation.
Yes, the overall FTC limitation is crucial. The U.S. doesn't want foreign taxes offsetting U.S. tax due on your U.S. domestic income. So the credit is capped. The formula is basically your total U.S. tax liability, before the credit, multiplied by a fraction. That fraction is your foreign source taxable income divided by your total taxable income worldwide.
So if only, say, 20% of your total income is foreign source, you can only use FTCs to offset a maximum of 20% of your total U.S. tax bill.
That's the essence of it. It limits the credit to the U.S. tax that would have been due on that foreign income.
Now, things get complicated when we talk about credits for taxes paid by a CFC on income that's imputed to the shareholder under Subpart F or NCTI, especially the difference between individuals and corporations.
Drastically different, yes. For an individual U.S. shareholder, the general rule is harsh. You typically cannot claim a direct FTC for the underlying foreign taxes paid by your CFC on the income that's being imputed to you. Why? Because the corporation paid the tax, not you personally.
Seems unfair. Is there any way around that for individuals?
There is one main way, the Section 962 election. An individual can elect to be taxed on their Subpart F and NCTI inclusions as if they were a domestic corporation.
What does that achieve?
By making that election, the individual pays U.S. tax on the imputed income at corporate rates initially, but they then become eligible to claim an indirect foreign tax credit for the foreign taxes paid by the CFC, just like a U.S. corporate shareholder could. When the income is later actually distributed, there's another layer of tax, but the election often results in lower overall tax due to accessing the credit. It's complex, but often beneficial.
Okay, so individuals need the 962 election. What about U.S. corporations that own CFCs? How do their credits work for imputed income? It involves baskets, right?
Yes, the FTC limitation for corporations, and individuals for that matter, is further complicated by income baskets. Foreign income and the associated taxes are generally segregated into different categories or baskets, like a passive income basket, the GILTI NCTI basket, and a general limitation basket for active business income.
And the rule is you can only use taxes from one basket to offset U.S. tax on income in the same basket.
Generally, yes. You calculate the FTC limitation separately for each basket. This prevents you from using excess credits generated by high-taxed active income, for instance, to shield low-tax passive income from U.S. tax.
And our sources highlight a key difference in the credit rules, specifically between Subpart F income and NCTI income.
A very important difference, reflecting policy choices. For foreign taxes deemed paid on Subpart F income, a U.S. corporation can generally claim a 100% indirect FTC, subject to the basket limitations. And if they have excess Subpart F credits they can't use in the current year, they can carry them back 1 year and forward for 10 years.
Okay, 100% credit. Carryovers allowed for Subpart F. What about NCCI or GILTI?
It's much stingier. For foreign taxes deemed paid on NCTI GILTI income, the indirect FTC is subject to a mandatory haircut. Only 90% of the foreign taxes paid are creditable against the U.S. tax on that income. The U.S. deliberately ensures it always collects at least 10% of the U.S. tax, regardless of the foreign rate.
A 10% mandatory U.S. tax, effectively. And what about carryovers for NCTI credits?
No carryback or carry forward allowed for unused FTCs in the NCTI basket. If you can't use the credit in the year the NCTI is included, it's lost forever. Use it or lose it. Much harsher than the Subpart F rules.
Wow, okay. Big differences there. Now let's touch on that specific geopolitical point mentioned. Foreign tax credits for taxes paid to Russia. What's the current status?
Despite the ongoing conflict and sanctions, as of the information in our sources, U.S. taxpayers can still generally claim an FTC for income taxes paid to Russia. The right comes from the U.S.-Russia Tax Treaty. Though it's suspended, certain provisions might implicitly survive, and primarily the general FTC provisions in the Internal Revenue Code itself.
Why haven't they been blocked? Isn't there a rule for countries we have issues with?
There is. IRC Section 901 denies FTCs for taxes paid to countries the U.S. doesn't recognize, has severed diplomatic relations with, or designates as state sponsors of terrorism. Russia is not currently on that specific 901J list.
And there was an attempt to change that.
Yes, the Wyden-Portman Support Ukraine Through Our Tax Code Act back in May 2022 specifically tried to add Russia and Belarus to the list of countries under 901J, which would have blocked the FTCs, but the bill stalled.
Why did it stall?
Sources suggest significant pushback, partly from U.S. companies that still had operations, assets, or employees stuck in Russia and needed the FTC to avoid punitive double taxation on income they couldn't easily repatriate. It highlighted the tension between foreign policy goals and protecting U.S. business interests abroad.
Interesting. Okay, shifting from credits to deductions. There's another benefit specifically for U.S. corporations related to exports. FDDEI.
Right. FDDEI, Foreign-Derived Deduction Eligible Income. It's under Section 250, the same section that provides the NCTI deduction. FDDEI is the successor to an earlier regime called FDII, and it aims to incentivize U.S. companies to generate income from exports of goods and services to foreign markets, and importantly, to keep the related intellectual property IP in the United States.
How does it work? Is it layered with the NCTI deduction?
It is. The total Section 250 deduction for a corporation is the sum of two parts. Part 1 is 33.34% of its FDDEI. Part 2 is that 40% deduction for its NCTI inclusion that we already discussed. So exporting activities generate their own deduction, separate from the minimum tax deduction.
And the goal is to make it cheaper, tax-wise, to serve foreign markets from the U.S.
Exactly. Lower the effective tax rate on income derived from foreign sales or services provided from the U.S. Keep the jobs and the IP onshore.
Is there an anti-abuse rule? Like, can a U.S. company just sell to its own foreign subsidiary and claim the deduction?
No, they thought of that. There's a crucial related party rule. If the sale of goods or services is to a related foreign party, the income only qualifies for the FDDEI deduction. If that related party then sells the goods or uses the service in a transaction with an unrelated non-U.S. person or uses it in providing a service to such a person, you can't just shift profit internally to get the deduction. It has to relate to an ultimate sale to an unrelated foreigner.
Makes sense. Does FDEI face the same international challenges as its predecessor, FDII, like being called an illegal export subsidy?
Yes, that's an ongoing issue. The World Trade Organization, WTO, rules, specifically Article 3 of the Agreement on Subsidies, generally prohibit export subsidies. Trading partners, especially the EU, have argued that regimes like FDII and potentially FDDEI violate these rules by giving U.S. exporters an unfair advantage based purely on exporting. It's a persistent source of trade friction.
Okay, one last area of relief, this one specifically for individual Americans living and working overseas. Section 911, the Foreign Earned Income Exclusion, FEIE.
Yes, the FEIE is absolutely vital for many U.S. expats. It allows qualifying individuals to exclude a significant amount of their foreign earned income from their U.S. gross income.
Emphasis on earned income.
The emphasis. It applies to salary, wages, professional fees, self-employment income earned through personal services. It does not apply to passive income like dividends, interest, capital gains, pensions, or annuities. If you're living abroad and sell stock for a profit, that gain is generally fully taxable in the U.S. FEIE doesn't touch it.
And how do you qualify? You need a tax home abroad, plus.
Plus, you need to meet one of two tests. Either the bona fide residence test, you have to be a genuine resident of a foreign country or countries for an uninterrupted period that includes a full calendar year. Or the physical presence test, you just have to be physically present in a foreign country or countries for at least 330 full days during any 12 consecutive months period.
330 days, that's pretty specific. Is there a limit on how much you can exclude?
Yes, there's an annual maximum exclusion amount, indexed for inflation. For 2025, our sources estimated around $130,000 per qualifying individual. So a married couple, if both qualify, could potentially exclude up to $260,000 of their combined foreign earned income.
What about self-employed people whose business involves capital, not just services, like a shop owner?
There's a limitation there. If capital is a material income-producing factor in your self-employment business, the amount you can treat as earned income eligible for the FEIE is capped. It generally can't exceed 30% of your share of the net profits from that business. Prevents sheltering business profits that are really a return on capital, not just labor.
Okay, and tied to the FEIE is also relief for housing costs.
Yes, the foreign housing exclusion for employees with employer-provided funds, or deduction for self-employed individuals.
Okay.
This allows you to exclude or deduct foreign housing expenses that are considered reasonable but also exceed a certain base amount.
How does that calculation work? Housing costs minus a base amount.
Exactly. The base housing amount is set by formula. It's 16% of the maximum FEIE amount for that year. So you take your actual qualified housing expenses, rent, utilities, etc., up to a reasonable limit, often capped by location, subtract this base amount, which represents housing costs you might incur anywhere, and the excess may be excludable or deductible. If your costs don't exceed the base, you get no housing benefit.
And the big trade-off, if you claim the FEIE or the housing exclusion deduction, what can't you do?
This is critical. You cannot claim a foreign tax credit or deduction for any foreign taxes paid on the same income that you've excluded under the FEI or the housing exclusion. You have to choose. Either exclude the income from U.S. tax altogether or include the income and claim a credit for the foreign taxes paid on it. You can't do both for the same dollars.
Right. We have definitely gone deep today. We've covered this huge landscape of U.S. rules trying to tax income globally. Let's try to just quickly recap the main pillars.
Okay, Pillar 1. The CFC regime, triggered by control, more than 50% owned by 10% plus U.S. shareholders. It imputes certain types of easily shifted or passive income, Subpart F, and the broader minimum tax, NCTI, back to those U.S. shareholders currently.
Pillar 2, the PFIC regime, the backstop. No ownership threshold for the U.S. investor, triggered by the foreign company itself being passive, 75% income test or 50% asset test. The default tax treatment is highly punitive, pushing investors towards QEF or MTM elections for current inclusion.
And Pillar 3, the relief mechanisms. Primarily, the foreign tax credit, FTC, to alleviate double taxation, but with complex limitations, baskets, and different rules for Subpart FBCS NCTI. And for individuals abroad, the Foreign Earned Income Exclusion, FEIE, for earned income, plus the housing relief, but forcing a choice between exclusion and credits.
I think the big takeaway for anyone listening, especially if you have international connections, is that the details really matter. It's not just broad principles. It's the 10% shareholder definition, the 18.9% high tax cutoff, that 20% substantial transformation test for sales income, the 70% full inclusion rule.
Absolutely. And that nasty PFIC overlap issue for the sub 10% owners caught by attribution. The mechanics are everything in this area.
And watching the shift from GILTI to NCTI, getting rid of that QBAI tangible asset benefit, it really shows the constant evolution, doesn't it? The Treasury is always refining its aim, trying to pinpoint where income, especially mobile, intangible income, is really being generated and ensuring it gets taxed somewhere, preferably at a minimum rate.
It's a continuous process of trying to close loopholes as global business structures evolve.
Which brings us to our final thought for you, the listener. We've seen this hierarchy. CFC rules generally trump PFIC for major shareholders. Subpart F rules, targeting the most mobile income, generally apply before the broader NCTI minimum tax. So the question is, what's next? After focusing so heavily on corporate intangible income with GILT and CTI, what might be the next, perhaps smaller, category of income or type of structure that the U.S. Treasury decides is escaping the net and needs a new targeted anti-deferral rule?
Could be complex financial instruments, specific types of trusts, maybe income streams currently falling just outside the existing definitions. The hunt for untaxed or low-tax foreign income is likely far from over. It's always a moving target.
Indeed. A fascinating, if incredibly complex area. Thanks for joining us on this really deep dive into U.S. global taxation. We hope this helps you make a bit more sense of it all.